If you've been watching these videos regularly in calendar year 2017, it's possible at some point when presented with a long-term bullish breakout, you might have thought to yourself, those charts are meaningless because algorithms and passive investing have changed everything. And more specifically, we'll look at the impact of technology, including ETFs and computerized trading. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Some of you may remember back in August of 2016, we covered a signal that had only occurred 10 other times in the past 35 years. And like all of the videos we've covered over the past year or two, they are all based on hard data rather than opinions or a hypothesis about the impact of something on the financial markets. And despite covering radical and bullish shifts in the data 11 months ago, showing 5 months ago that the present day looked a lot more like a major bottom and really didn't look anything like a major top, and despite the very bullish breakouts that we've covered in the technology sector, and the very rare annual signal that was last seen before the 1982 bull market run in stocks that lasted into the spring of 2000, and despite the numerous present-day and bullish market fractals that we've covered, and countless long-term consolidation periods that were followed by bullish breakouts, including this analysis dated December 30th, 2016, where we said the longer a market goes sideways, the bigger the move we can expect to get. Almost a year later, we have seen favorable moves in this direction. And back here, we were talking about the fact that harder markets are typically followed by easier markets marked by stronger and longer-lasting secular trends. Thus, despite all of the bullish charts and all of the indisputable facts, understandably, there are still concerns, including concerns related to trading algorithms and passive investing. Let's turn back the pages of history to help us understand a little bit more about the present day. This is the S&P 500. This is a monthly chart. This is 1932 on the left side of your screen. This is a bullish breakout that we could see, measure, and put in a model in 1950. In the present day, many people are saying you have to ignore these bullish breakouts because ETFs have changed everything. Well, ETFs aren't particularly new. They've been around for a long time. The inception date for SPY, or the S&P 500 ETF, was way back on January 22nd, 1993, which is 25 years ago. If we go back in time here, we have a long-term consolidation box. Stock market went sideways for years between 1932 and 1950, and we get that bullish breakout. In the present day, we have something very similar that occurred in many markets over the past 2 to 3 years, and we know the longer we go sideways, the bigger the move that we can expect to get. And since many are concerned in the present day about an invention, something that hit the market 25 years ago, we could have been skeptical about this breakout in 1950 because there were numerous technological advances that had taken place over the past 25 to 30 years, including in 1924, the first mutual fund was born. And you could make an argument that in 1924, that's when passive investing began. Mutual funds have been around for a long time. These funds all have inception dates between 1924 and 1931, and all of them are still active in the present day. So pooling money or pooling stocks, very, very similar to what an ETF does in the present day, a basket of stocks, has been around for a long, long time. It's really nothing new. Mutual funds have been doing it since the 1920s. Therefore, in 1950, it would have been very, very easy for us to look at this clear and indisputable bullish breakout on this chart and say those charts are meaningless because mutual funds have changed everything. That breakout in 1950 is meaningless because television has changed everything. The advent of memory will and has changed everything. Those charts are meaningless because lasers have changed everything. Optical character recognition has changed everything. Those charts are meaningless because transistors have changed everything. It's a nice looking breakout you have back in 1950, but space rockets, they've changed the game. It'll never be the same. So while many are saying we should ignore the charts in the present day when we have bullish breakouts because ETFs and algorithms have changed everything, we could have made the exact same argument using numerous technological advances that had occurred in the rearview mirror looking back 25 to 30 years. Let's assume we had done that and said, this chart's meaningless. We would have missed a 515% gain that took place over 22 years. And remember, at the beginning of the video, we said way back in December of 2016 that the longer a market goes sideways, the bigger the move that we can expect to get. 515%, that's a big move, and 22 years is a long period of time. How about the flash crash? In the short run, significant. In the longer term, a blip on the radar. This is the point-to-point move. This is before the flash crash. We had a bullish trend in place. This is 2009, 2017. This is the S&P 500 point to point. The big money is not made in the individual fluctuations, the flash crash, but sizing up the entire market and its trend. If I held an ETF and I was investing based on the primary secular trend, if I held it from point A to point B, the flash crash basically had no impact at all. There were numerous takeaways from the flash crash, and we have numerous policies in place in terms of how we would handle our ETFs if something similar happened in the future. Now you may be thinking, well, what about trading algorithms? They've changed everything. If there was ever a time in history where we might have been skeptical about technology, it would have been immediately following the 1987 crash. Therefore, late in 1987 or early in 1988, many people were saying the charts that you're looking at today are meaningless, and the ones that you're looking at in the past are meaningless because computerized trading has changed everything. Algorithms on Wall Street are nothing new. Computers have been trading stocks for a long, long time. Therefore, if we had said in late 1987 that technology has made all the charts and historical comparisons meaningless, would that have been helpful? Or would it have been helpful to continue to look at the hard data and make decisions based on what's in front of us rather than a hypothesis or conjecture of how some type of technology may or may not impact the markets? In this case, if we were skeptical about technology here in early 1988, late 1987, we would have missed a 582% gain. This is after Black Monday. Stocks rallied from late 1987 all the way into the spring of 2000. Once again, reinforcing our focus should be on the longer term primary trend and the data that's in front of us. Sometimes that data is constructive. Sometimes that data is clearly bearish. If you followed the markets back in 1987, you know it was very, very common to hear something like this statement that we hear in 2013, 2014, 2015, 2016, and 2017. Algorithms, they've changed everything. They make all historical comparisons obsolete. Let's double back to mutual funds, their impact on the markets, and tie it into the argument that those charts are meaningless because ETFs have changed everything. There are numerous ways to invest in stocks. 3 of the most popular we'll talk about. We can buy individual stocks, and we know that some people hold stocks forever and basically never execute trades. They are true buy and holders. We also know that some people trade their stocks infrequently. And with the advent of day trading, it's clear to all of us that some people trade individual stocks frequently, including computers that trade them on very short time frames. When mutual funds came along in the 1920s, some people bought mutual funds and held them forever. They were true buy and hold investors. Some people trade mutual funds infrequently, and some people, especially in the present day, it's very, very common with Fidelity sector funds. It's been around forever. There's all kinds of strategies related to Fidelity sector funds. Some people trade mutual funds frequently. There's nothing about a mutual fund that implies someone is a passive investor. Just like a stock, a mutual fund can be traded infrequently, frequently, or held forever. And in a similar way, some people buy ETFs as true passive investors. I'm in it for the long haul. Some people trade their ETFs infrequently, and some people day trade ETFs. It's a misnomer to believe that 100% of the dollars that are going into mutual funds are 100% passive funds held by passive investors. It's also a misnomer to say that all of the money that's flooded into ETFs, those are passive investors and they're buy and holders, and in the future at some point they might panic and hit the sell button. Just look at the trading volume on any ETF. Our firm is a good example of this. Sometimes we hold ETFs for a long period of time. Look at our SPY positions in calendar year 2017. Basically have made no trades and have held the position for the entire year. Sometimes we trade infrequently. We have made some moves with ETFs this year. And when markets are going sideways and they're indecisive, we probably fall into this category. We'd prefer not to be here, but sometimes we are to manage risk. In fact, it's a little bit ironic that ETFs basically were created to reduce the probability of a market crash. After the 1987 crash, the SEC came out with a white paper where they suggested if market makers could have turned to a single product for trading baskets of stocks, the market damage and volatility may have been significantly smaller. Out of that guidance and from that white paper, what we know today as ETFs emerged. The only major difference between an ETF and a mutual fund is that an ETF can be traded during the day like a stock. A mutual fund, if I submit a sell order on Black Monday at 10 a.m., I can put my order in at 10 a.m., but it will not execute until 4 p.m., and I'll get the price at the close. There's all types of counter-arguments and arguments about the impact of ETFs. There's no question that mutual funds changed the markets. ETFs changed the markets. But even during the 1987 crash, people were submitting sell orders for mutual funds, and the mutual funds during the day were hitting the sell button, preparing for those redemptions at the end of the day. ETFs are different, but they are very, very similar to mutual funds. One of the constants in the markets is change, technological innovation, and financial innovation, including new ways to trade and new vehicles. The major constants in the equation, dating back to the beginning of time and markets, are greed and fear and human beings. The variables are the transmission mechanisms. So the transmission mechanism between a human being that has greed and fear, there's a transmission mechanism between them and the market. And technology and investment vehicles are transmission mechanisms. They vary, and the market does have to adjust to them from time to time. But on the other end of trading algorithms and ETFs and mutual funds are human beings and greed and fear. From Jesse Livermore, I learned early that there is nothing new in Wall Street. There can't be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again. I've never forgotten that. This quote here is based on this constant, which is greed and fear, and ultimately human beings. From the book Market Wizards, this sums it up. People and psychology do not change. Technology, investment vehicles, ultimately transmission mechanisms change. People remain, for the most part, constant. That's why we had a tulip bulb frenzy and a dot-com bubble, and soon thereafter, a housing bubble. To say that mutual funds or computers or ETFs had no impact on the markets, that wouldn't be accurate either. Of course they've had an impact. Sometimes it takes time for the market to adjust to a new transmission mechanism. And computers and computerized trading did play a role in the 1987 crash. However, as we covered last week, the big money is made in sizing up the entire market and its trend. Prior to the 1987 crash, the secular trend was unequivocally bullish. 229% gain before Black Monday in the S&P 500. After the individual fluctuation, and this is an individual fluctuation based on market fractals, we returned to the secular trend that was unquestionably bullish and tacked on an additional 582%. Computerized trading did impact the markets, but it didn't change things over the long haul. Markets eventually adjust. As we've covered over the past few weeks, we know that technicals were constructive, so if we fast forward a week to Friday, October 27th, 2017, according to MarketWatch, S&P 500, NASDAQ end at records as tech rally powers gains. We also know that the Dow has been posting numerous new all-time highs. Therefore, things looked good a week ago. Logic tells us that they probably look good again this week with new all-time highs and gains over the past 5 trading sessions. Therefore, does the present day look anything like this bearish look that we could see, measure, and put in a model before bad things happen, or this bearish turn that we could see, measure, and put in a model before the market dropped an additional 56% in the financial crisis? As you might imagine, the answer is no. It doesn't look anything like that. Here are the same moving averages as of the close on Friday, October 27th, 2017. And as we've noted in past videos, rather than looking like something we should be concerned about in the present day, the present day continues to look like a sustainable trend. After we could see this measured and put it in a model, the S&P 500 gained an additional 156%. And in this case, after we could see this, measure it, and put it in a model, these are facts, no opinions, the market tacked on an additional 26%. Last week, we said that the trend strength model, 100% of the questions we were asking came back with bullish answers. That's true as of Friday, October 27th. As we've noted, we can be confident about the facts that we have in hand. We'll continue to take it day by day and maintain that flexible, unbiased, and open mind. If things change, we'll make adjustments. Taking it day by day and allocating based on the facts has worked very, very well since the U.S. election. And fortunately, our positions are performing well, and this quote still applies. As long as a stock is acting right and the market is acting right, do not be in a hurry to take a profit. And even if good things happen from a point A to a point B, we know with 100% certainty there is going to be gut-wrenching volatility between a point A and a point B. Giving back some of our gains is always part of the equation when we're trying to move from a point A to a possible point B that could be several years down the road. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.